What happens when a tax return says a restaurant brought in about $1.6 million and then the government says no, the real story is closer to about $3.9 million? The return shows up late in September 2018 for tax year 2015, and suddenly the gap isn't just paperwork, it's money. An increase of around $2.3 million in alleged receipts. And when the dust settles, the government is willing to allow only about $82,000 as non-income deposits, leaving roughly $2.2 million still on the table as the disputed amount of revenue. Not a paperwork problem, a receipt problem, a proof problem, and by the end, a credibility problem. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this kind of real-world drama, please like this video and subscribe, because this channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law actually works. In this video, we cover the tax court decision in the case of Klinko versus Commissioner of Internal Revenue, decided on February 9, 2026. The case starts with the taxpayer, an attorney whose practice focused on real estate leasing and representing small businesses, but who in the court's words was also an entrepreneur who spent much of his time running a restaurant and a bar near UCLA, operated through an entity called MedCafe Westwood LLC. The restaurant wasn't portrayed as a tiny side hustle. It was a family business, with the taxpayer owning a controlling share, a brother holding the remaining share through 2014, and another brother serving as a manager and bookkeeper. The taxpayer handled vendors, landlords, the city, and other third parties, supervised daily operations, and spent around 30 hours a week on the restaurant. Then in 2015, the structure shifted. He converted MedCafe into a single-member limited liability company. Operationally, MedCafe had approximately 60 employees, most working short shift. Tips were part of the daily rhythm, but the restaurant did not record the tips or claim tips deduction. Employees received tips at the end of each day, including cash paid by customers that were not deposited into MedCafe's bank account, and employees were themselves responsible for recording the tips that they earned. The taxpayer later estimated 90% of MedCafe's income came from credit cards and 10% came from cash. Then we get to the tax return that sets everything in motion. The taxpayer prepared his own 2015 partnership return and his own individual return, filing jointly with a spouse. And the court makes a point of the timing. It was filed late, with the IRS receiving it in September of 2018. On the 2015 Schedule C for MedCafe, the taxpayer reported gross receipts of more than $1.6 million. He claimed about $1.4 million in cost of goods sold and about $600,000 in total expenses, reporting a net loss of roughly $400,000 for MedCafe. But the restaurant wasn't the only storyline. The couple also had 2 rental properties in Pasadena and claimed depreciation on Schedule E. On Form 4562, attached to the schedule, the taxpayer stated the properties were placed in service in May 2015. One property was an apartment building with the claimed basis of $1.8 million and depreciation of roughly $41,000. The second was a single-family home with the claimed basis of about $700,000 and depreciation of about $16,000. Total claimed depreciation added up to roughly $57,000. Enter the audit. A revenue agent began examining the returns in 2019. The taxpayer was already quite sick, and an accountant handled much of the discussion. Still, the revenue agent met with the taxpayer personally, discussing the delinquent filing, requesting documents, and trying to understand health concerns that contributed to the delays. And it's in that meeting that the taxpayer estimated the key ratio. About 10% of restaurants' revenue were in cash. Conversations continued through late 2020. The revenue agent saw a discrepancy between the gross receipts reported and what appeared consistent with the credit card sales to cash ratio. And that triggered the next move, a summons of bank records and bank deposits analysis. Multiple accounts were reviewed, several Chase accounts and City National accounts. The agent reviewed deposits and tried to separate transfers and other non-taxable items from taxable business income, including deposits tied to card processors, UCLA, Grubhub, check payables to the restaurant, and cash deposits. Then comes the outside information, third-party informational return data, pulled from IRS system, looking for payments to the restaurants. The revenue agent identified 4 key information returns: Form 1099 missed from UCLA, 3 Forms 1099K from First Data Reporting, American Express, and Grubhub. The opinion actually lays out the amounts. UCLA about $36,000, First Data Reporting about $1.4 million, American Express about $615,000, and Grubhub about $21,000. And then the agent adds what the taxpayer himself supplied. The admission of estimated cash receipts, about $229,000, representing 10% of cash estimates. Those items are summed up together to about $2,290,000 in total. So the notice of delinquency goes out with a short menu of adjustments: underreported gross receipts, unsubstantiated depreciation for the 2 Pasadena properties, an untimely filing penalty is an addition to that tax, and an accuracy-related penalty as well. And then the story takes a turn that changes the posture of everything. Within months after the commissioner sent the notice of delinquency, the taxpayer passed away. The court frames 3 questions: whether the notice of deficiency was invalid because it wasn't properly signed, whether the restaurant's income was understated, and whether the taxpayer was entitled to the depreciation. The signature fight begins with the misconception that the opinion corrects immediately. The taxpayer argued that a notice of deficiency had to be signed in ink by an IRS employee with delegated authority. The court wasn't buying that. The opinion states flatly that the letter identified as letter 531 is the notice of deficiency, as the bold typeface heading of the first page declares, and that the examination report was merely listed as an enclosure. The letter had the name of a technical service territory manager with initials that indicated the signature was imprinted by a delegated official. The court adds that the internal menu provides multiple ways of signing, including delegation, typed names, and electronic images, and concludes that the notice satisfied those internal requirements. But the court goes further. Even if it hadn't, the opinion says case law establishes that even an unsigned notice of deficiency is valid, noting that the code does not expressly require a notice of deficiency to be signed, and calling the question settled. The signature argument wasn't just weak, it was the wrong battlefield. And then the court calls out the taxpayer's attorney for citing cases that don't exist, describing 3 or 4 cited cases as hallucinations generated by a large language model AI. The court says the presence of such references is unacceptable and warns that submitting briefs with false case law is a recipe for sanctions. Then it quotes advice attributed to the Chief Justice: using citations to non-existent cases is always a bad idea. Translation for non-lawyers: if you're going to fight the government, you can't do it with imaginary ammunition. Now back to money, the big dispute. The notice identified 3 categories of underreported revenue: the Form 1099 MISC amount of about $36,000, Form 1099K totaling about $2 million, and estimated cash receipts of about $229,000. Then comes the one concession. The commissioner agreed some checks for capital contribution trimmed off about $82,000 and still asserted underreported gross revenue of roughly $2.2 million. The taxpayer tried 3 angles. First, that the government didn't sufficiently substantiate the sources. Second, that the capital contributions were misclassified as income. Third, that the restaurant was never profitable, even mentioning bankruptcy. The court treats the first as mostly smoke. It notes that while there was early confusion about identifying a specific source, by trial the issuers behind Forms 1099-K were identified and the Form 1099 were pulled through the IRS system. The cash estimate, the court says, came from the revenue agent's interview with the taxpayer himself. Then the legal storytelling bit. The government can reconstruct income when the taxpayer's method don't clearly reflect income. And the reconstructions need only be reasonable in light of all surrounding facts and circumstances. Once it's in the notice, it's presumed correct unless the taxpayer proves it wrong or arbitrary. The court says these sources weren't arbitrary and the taxpayer didn't prove they were incorrect. The taxpayer offered possibilities. Maybe the IRS confused Mad Cafe with another UCLA restaurant, and maybe IRS records were error-prone. The court's response is blunt, entirely speculative, with no substantiative evidence. So the court finds the commissioner correctly identified the income from the Form 1099 and the estimated cash receipts. On capital contribution, the taxpayer said he deposited more than $385,000 of personal funds into the restaurant accounts and claimed the commissioner treated them as income. The record showed that after the notice the taxpayer email detailed, the revenue agent accepted about $82,000 as capital contributions and revised the calculation before the trial. But the court says there was no evidence of additional contributions beyond what was accepted and that an email without more wasn't enough to prove the bank deposits analysis wrong. And profitability? The court's reply is almost tagline. Even money-losing businesses can have underreported income. The opinion ends the revenue section with the simple verdict. The commissioner wins this one. Finally, depreciation claim. For 2015, the taxpayer claimed about $57,000 of Schedule E depreciation for 2 rental properties allegedly placed in service in May 2015. He reported basis of about $1.8 million and about $700,000, but provided no substantiation for the basis and no evidence of when the properties were placed in service. His argument, as the court recounts it, was basically he claimed the same depreciation in 2017 and the IRS didn't question it. The court answers that with the boring rule that destroys the deduction. Taxpayer must prove depreciation with adequate records. It lists the kind of proof usually needed, such as purchase and sale invoices, closing statements, canceled checks, evidence that show basis, cost, useful life, and prior depreciation. And it draws the line, claiming it later isn't proof you were entitled to it in 2015. The conclusion is the tax court's equivalent of you lose, but we'll do the math carefully. The commissioner prevails on most of the issues, but because gross receipts were revised to reflect the capital contribution deduction, the final computation will be entered under Rule 155. So what's the lesson on this one? If you're going to tell IRS your cash is 10%, don't be surprised when that turns into a number with 6 digits attached. If you want depreciation, bring receipts and records, not vibes, and they didn't audit me last time argument. And if you're going to argue in court, don't show up with hallucinated cases and hope the judge won't notice. This judge noticed. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video and found this information useful, please like this video and subscribe to this channel. I'll see you in the next tax court case review.